Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
Well, g'day everyone, it's Liam Garman here, co-host of the Defence Property Podcast, of course, with my amazing co-host Kane Dury from Discover Buyers Agents. Mate, back in the studio again.
Back again, mate. We had a studio off last month.
I know you dialed in via Zoom.
Yeah,
you broke
Zoom.
my heart.
Yeah, I know. It's just not the same.
It's not.
Yeah,
it's not the same.
It's not the real podcasting experience.
We lose the human touch. And, of course, the human touch is what we need in the world of property and property investing because, as you and I speak about quite frequently, you know, we very much advocate for first-home buyers or investors to partner with people in the know. You've seen it 1,000 times. I've seen it 1,000 times. I'm not sure if you've done it yourself. I've done it myself, or I've made mistakes because I've gone solo.
Yeah.
And we always want people to surround themselves with the best of the best, whether it's buyers, agents, mortgage brokers, accountants. Do what you can because these guys can unlock some amazing insights for you on your journey. But just this week, over the last few days, now I've got to be careful of time stamping it. Big news. What happened? RBA.
Interest rate decreased by 0.25, so the reserve sitting at 3.6 now. So pretty much every real estate agent, mortgage broker, buyer's agent, and anyone else that touches the industry has probably had some sort of social media post about, you know,
yeah,
Reserve
I think
Bank.
I sent out about 10 bloody emails about
and
it.
emails. But what I guess what it actually means is, you know, with a mortgage of, you know, if the median price in Australia is, you know, around that, close to that million, including the capitals, the new mortgage now is probably sitting around 700,000 for a lot of first home buyers. 0.25% represents about $33 a week, you know, $145 a month. So that's the actual, you know, the impact to you. Hopefully there's a couple more, and if we could get maybe another 0.5 decrease by the end of the year, you know, a couple more quarters or whatnot, you know, that's another 33 each time it goes down by a quarter. So positive signs.
Yeah, it certainly adds up, especially if you do have a few more rate cuts on the horizon. I think it's Westpac is the most bullish about it at the moment. And for our listeners who might not be familiar, a lot of the four major banks, they all kind of forecast their predictions. They're very open with their predictions on rate cuts. So Westpac is the most bullish, and they're predicting 4 rate cuts, including the one this week. So 4 in total.
So another 3 to go.
Another 3 to go, one in November, and then I think 1 in November, I think 2 early next year.
Gotcha.
I think most are predicting a hold in September, but yeah, at least 1 later in the year and then 2 early next year. NAB comes in second with 3 rate cuts they're predicting, 3 including the one this week, so an extra 2, which again will be in November and potentially early next year for 1 more. And CBA, Commonwealth Bank and ANZ are a little bit more conservative. They're just predicting 1 more after this, which will likely come through in November. So there is also further relief on the horizon. Now, for people with a mortgage at the moment, it does represent a little bit more money in your back pocket. So whether you're looking to scale, yes, you'll have a bit more money there, but also it increases your borrowing capacity. So I saw some recent data that came out from Domain that if you're a single income earner on $50,000 a year, $4,000 you can borrow more. Now it seems quite tame, but that's based on your current earnings. So you can borrow $4,000 more. In that entry-level property market, $4,000 is not too bad, but all the way up to a family dual income up to $400K a year, obviously very much on the higher end. You can borrow up to $49,000 more, and that's just off the back of a single rate cut. So if you do have a few more coming down, you will see that borrowing capacity loosen a bit.
That's 100 to 200, isn't it? Whether we get 2 cuts, like one that we've just had and another, or like Westpac, 1 and 3 more. That's the difference of 100 to 200,000 more that you can borrow to buy. And that could be the difference between getting that 4th bedroom, depending on how many kids you got. And the reality is when interest rates are at the highs, just to get into the market, it's quite a struggle for a lot of families. and families with 2 kids are saying, well, we have to go a 3-bedroom because that's all we can afford, and we don't want to go down to townhouse or units. So we buy a 3-bedroom house but with 2, 3, or 4 interest rate cuts, adding another 100 or 200 could be the difference between getting that 4th bedroom.
Oh, for sure.
So it is impactful, not only on just getting into the market for people, but opening up another actual bracket of properties available, or the other side is opening up a broader range of suburbs that weren't really accessible when interest rates were higher.
We throughout the podcast we're gonna touch on a few things, in particular that finance aspect and some of the old debates over LMI, but in particular looking at it from a defence aspect, the reserves. And I always find it interesting speaking to a lot of reservists. A lot of reservists don't actually realise that they are able to access some of the benefits that you and I speak about quite openly, but people like DHOAS, the Defence Housing Ownership Assistance Scheme, a lot of people put that into Circat 7 land. They think, well, I won't be able to access it as a reservist, but you do have the ability to access it. Can you talk us through that?
And I think we can actually broaden we got the reserves who are active, and we can broaden this conversation to include the veteran community as well.
Yeah, right.
Because once you separate and you don't go reserves, you can still get DHOAS if you've never had it. You just need to apply through DVA for your certificate, and depending on your years of service and all other things, you can go get DHOAS as well. But the thing with the reserves, meeting the minimum amount of days per year, around 20, you're still actually accumulating entitlement to DHOAS. So although the brackets are longer to go up the tiers as a reservist, if you're meeting the minimum requirement, you're still actually accruing DHOAS entitlement. So, it's definitely open to the reservists out there. And I've actually had quite a few meetings and calls from the reservist community because I guess they're probably more starved for information around DHOAS and defence property entitlements. There's a real lack of education and transparent sort of, or passing on of information. And the defence reservist community is certainly, because they're not around the water bubbler, down in the boozer with the boys or whatnot, or at the mess, talking about all these things. So they're just not exposed to the conversation as much as the full-timers. But even the full-timers do, sort of have, don't get the information they're looking for, I guess. So,
I mean, if you're working a few hours or a few days a week, I mean, you're going to be focused on the task at hand. You're not necessarily going to be 100%. Able to spend a lot of time on the intranet. Actually, hey, what am I entitled for? Because you're there for a few afternoons or a weekend. You got your job, and then you're kind of exhausted. You want to get back to your day job the next day. It's Sunday afternoon. You want to get home to your wife and kids who you haven't seen since Friday.
Versus 40 hours a week.
Yeah.
And even when you're doing 40 hours a week, you might not be that clued up either. So there's not much, not much resources available, I guess, to the reservists. So, key takeaway from today's episode is if you're a reservist or a veteran and you haven't used DHOAS, there's the opportunity. Obviously, there's the criteria that applies to anyone and everyone. You meet the criteria and DHOAS can apply to you.
I think the base level of DHOAS you can receive after 4 years. So basically, if you got your ADM, if you got your ADM, you're
as a reservist. Yep.
As a reservist, you've got your entitlement there.
That's right.
In terms of the veteran side, so and that quite interests me. So does DHOAS go forever for the life of that loan, or is it so
let's make up an example. Someone served 10 years and discharged, and let's say it was a voluntary discharge, and they never used DHOAS, never owned a property, and then 2 years later they're in the position they've changed careers and then they're doing whatever post offence. The qualifying criteria for Tier 1 is obviously 2 years. So and they serve for 10, so they've got 8 years worth of entitlement.
Right.
So that they've not used. Now, if they were serving, that would be Tier 1. Tier 3, sorry, the highest tier. Because they have administration discharge or voluntary discharge, they drop back to tier 1. You know, but they're tier 1 at current, excluding yesterday's interest rate announcement and presuming the banks pass all that on. But at rates as of yesterday, that's around $500 a month for tier 1.
It's not small.
No, that's right.
It's not small. And
Now, if your boss offered you $6,000 a year pay rise, you'd be stoked.
hell yeah, and that's I mean, it's not taxed, is it? It wouldn't be taxed. Is it just a reduction on the?
Well, it's a subsidy for
subsidy
for the loan.
So realistically, if you're getting a $6,000 subsidy, that's pretty much a $10K pay increase.
There you go.
When you think about it, and it is open for veterans as well, which I think a lot
That's
of
right,
people
so
really don't understand.
Yeah, just because you didn't use DHOAS can be used post service. You know, so you just need to apply through it through the normal means through the DVAL or DHOAS website. And then you just have to meet the criteria, live in the property for 12 months. So, and that's one we're getting a lot of conversations around as well. I never used it while I was in. Does it apply to me? This is,
hell yeah.
you know. And if you're a medical separation, and here's a key point is if you get a medical discharge and you've tier 3, you will retain tier 3 payments, not drop back to tier 1 like a voluntary discharge.
Wow.
And so that's probably a key takeaway as well.
Yeah.
And you know, and then you're talking potentially like ballpark figures, $1,000 per month.
Yeah, that's huge.
So especially if you've gone through that medical process, and you're transitioning your career or starting a new career or whatever you're doing, $1,000 per month.
That's huge.
Yeah.
Can you explain? So if you're so say you throughout your service you bought an investment property or you had an owner occupier that you moved towns, you got posted elsewhere, and you started renting it out, but you've never used DHOAS.
Yeah.
Is it similar to, say, a first home buyer's grant where if you rent vest, you kind of forego your first home buyer's grant?
Yeah. But DHOAS is different. DHOAS, you just have to buy and live in that property for 12 months post-purchase to meet the criteria. So you can own a property elsewhere, but if it's not your home and it's an investment, that's separate. DHOAS applies to, and then you can move away and still retain DHOAS on that property if you get posted away to a different locality.
So
but you must have 12 months and ideally 18 months on your posting order to qualify. So because you have to live in it for 12 months. So if you've got exactly 12 months on your posting order, you're going to go get pre-approved, find a property, settle on a property. You're generally not going to be able to have enough time to live in it for 12 months if you get posted away, at the end of that 12-month period. So you need at least 18 months to give yourself 6 months to execute it or make the purchase, move into the property and everything, and then live in it for minimum 12 months to meet the criteria.
So you've been posted to Townsville.
Yep.
You bought a house up there.
Yep.
You've now been posted to Brisbane. You've got that 2 years left. It's probably your last posting.
In Brisbane.
Yep. And you're like, okay, I want to buy a house here. This is where I'm going to settle. Family,
kids that's the perfect
here.
scenario.
Yeah. And then you use DHOAS and you can still claim DHOAS even though you've got your Townsville house.
Yep.
You can still claim DHOAS on your new owner-occupier in Brisbane.
Yep. As long as you're not using it elsewhere, like you never use it on that Townsville property.
Yeah.
And in this example, if you're saying they're going to, stay in Brisbane and probably look to discharge from Brisbane, and make that their, post-service home, that's the perfect scenario because while we're in defence, and we've talked strategy endlessly, I feel, about this, about rent vesting while we're in defence, but we then want to consider start using DHOAS when we're looking where is our forever home and where we're going to live post-service. Like many people, like myself as an example, joined from Adelaide and then spent time in Victoria, Sydney, Townsville, and we now reside and settled on the Gold Coast. But when I was in defence, I had no idea. I didn't know where I was going to be. Like I met my wife while I was serving and we moved around together a lot. And then at some point you make the decision, this is where we're going to, dig our roots in post-service and the kids are going to school here or whatnot. In my eyes, that's the perfect time to be using DHOAS because then it's additional income to service the loan that you actually want to be paying down. When we're in defence and serving, potentially building an investment portfolio and staying on rent assistance where we can have, assistance with our rent. So we're supercharging our rent vesting strategy essentially. Because by staying on rent assistance, we don't miss out on DHOAS. But if we use DHOAS too early in our defence career, we give up rent assistance. And depending on rank, region and marital status, rent assistance could be, $300, $400 a week. Like the Navy guys in Garden Island there, the rent is huge in Sydney City, so their rent assistance is much higher. That's 15, 20, 25 grand a year that you're giving up just so you can go buy a property that inherently is probably going to turn into an investment anyway when you get posted away. So in a lot of cases, it makes sense to let's just invest, opens up the broader Australian market to choose where we invest, not be at the mercy of the local market if we buy. We stay on rent assistance and we're in a better tax position because we've got an investment property, not a home, and we're not missing out on anything. We've got DHOAS or entitled to it. We're just going to use it later.
And we'll talk about rent vesting in a moment, but especially with that Garden Island example, one thing that comes to my mind is it's about balancing the lifestyle as well. And in those areas, you can get the lifestyle of, you could have a cool little unit in Potts Point or something, and you can live what is, for a lot of people, a multi-million-dollar lifestyle because you're getting that rental assistance. Actually, maybe at that point, it would be beneficial for you to stay on rent assistance and get those, build up that DHOAS time. And again, I think there's so much misinformation out there about DHOAS and maybe not misinformation, but just, rumours, gossip, misunderstandings because
it's got a barbecue advice.
Some pretty bad barbecue advice that people give around DHOAS. And I've heard some horror stories that, we've shared on this podcast before. But, for people that are tuning in for the first time, I've heard people come to me with advice from brokers and buyers agents saying like, no, don't bother with DHOAS. It's not worth it. Just because a lot of it is direct to bank is my understanding. So it's Defence Bank and NAB that offer it, but a lot of that is direct to bank. So if you go to a broker, the broker's kind of going to lose business if he refers you on, right?
Yeah.
So I've heard a lot of people get that advice of, no, don't go with it because your interest rate is marginally higher. So, but you want to be chasing the lowest interest rate. And you and I have spoken about this at length. It is one of the big challenges in not only property investing, but also buying an owner-occupier is so many people chase the lowest interest rate where actually at some points it's not the best outcome. So if you do use DHOAS and you go direct to bank, and you'll probably be given a slightly higher interest rate. Don't freak out, because if you're saving several $100s a month because you're getting DHOAS, you still got more money in your back pocket than if you got a lower interest rate. And the point that you gave about this week's rate cut is case in point. So we've had 0.25% rate cut, so from 3.85% to 3.6%. That adds to $33 roughly a week, $120-ish a month for 0.25% interest rate.
Yeah.
So if you're on a DHOAS, which is several $100s more, you've done the maths.
7, 1,000.
Yeah, you've done the maths on this across quite a few podcasts. It has to be like 1.5% difference.
Yeah.
And if you're going across major lenders, really there's not going to be 1.5% difference in the mortgage that you're offered.
100%. And brokers are writing, what is it now, like 80% of home loans or 76, it's up there. There's only 3 providers for DHOAS. So there's Defence Bank, Australian Military Bank, and NAB.
Yep.
It's not hard, and only 2 are direct to bank, and Australian Military Bank, the only channel or only bank open through the broker channel.
Yep.
But you can go shop all 3, and you can go talk to all 3 once and get their quoted rate. You can go back to all 3 a second time and say, NAB said this, Australian Military Bank said this, Defence Bank said this, and push them for the sharpest rate, and you will get some discounts.
So you can negotiate.
But you got to go talk to them and and say, because not always are they going to give you the best rate up front.
Yep.
So, and you're not going to do this if you're because policy plays a part here as well. So let's go back to the start where we were talking about that family getting the house with the fourth bedroom, with the borrowing capacity, the interest rate decreases, opens up. Take the decrease out of the equation. If you go to a broker, they've got the most conservative bank might lend a certain family $400,000, but a very different bank might lend that same family with the exact same circumstances. They've got 40 banks in their panel and they all assess income, assets and liabilities very differently. You might be able to get $700,000 for the exact same apples to apples scenario. Right? So going to a broker to look at all 40, policy plays a bigger part than rate. So it's policy first, then rate second. There's no point saying what's your sharpest rate if your unique circumstances don't qualify for that. And the sharpest rate's generally going to be 20 or 30% deposits,
Yeah.
So if you've got 5% deposit, you can't be expecting the sharpest rate in the market.
You don't expect to go in with the low fives at the moment.
Expect or find someone that's going to actually say yes and get you the loan, right? But when you've only got 3 that provide DHOAS, there's a lot less legwork that you need to put in. Talk to the 2 director banks, talk to a broker or whoever's got Australian Military Bank, will go direct to them and play them off against each other.
Yeah.
In
the best possible way.
Yeah. Can you give me a discount on lender's mortgage insurance? Can you lower the rate? What can you do for me if I come to you versus the other 2 providers? It's only 3 conversations, repeated a couple of times. It's worth the legwork.
And I think this actually might be a good time to unpack this, because I don't think this is something that you and I have really gone in depth on. And for a lot of people that are new to this podcast, that might be joining us for the first time, we want to provide some wisdom, I guess, from your lived experience, from your learnt experience, and how you help your clients at the moment. And some of that lived experience and lived wisdom around brokers versus director bank, because I think even people that I don't mean this in a negative way, but there are a lot of people that are super equity rich through luck. And what could the example be? And we want your luck to continue. By the way, we want everyone to get lucky. That's why we give this wisdom. But you could have been posted to Brisbane and then got a 40% return, and then been posted to Perth and then got a 60% return, and you might have rolled the dice perfectly, and you might be in your late 20s now rolling in equity. But you also might be rolling in equity but not necessarily know the intricacies of the broking channels. Can you give us an explanation of the difference between direct to bank via a broker as the 2 different options, but then also a lot of people, again, with the barbecue chat or the pub chat that a lot of people might have, there are also a lot of misconceptions about the world of broking where people think that they have to pay out of pocket for brokers. Can you explain the world of mortgage broking? Yeah, definitely. I'm just going to circle back to the DHOAS side of things and shopping the 3 providers, because I'm going to drop a bit of a bomb here, but ask about lender's mortgage insurance and discounting and waiving, not just interest rate. Yeah. Because I've heard one provider is considering, and in certain circumstances, they're open to discounting and waiving lender's mortgage insurance, the same as Medico packages and stuff. So ask the question about mortgage insurance as well as the rate. I'm coming back to the value of... Actually, we will continue with LMI, and then we'll get on to the broking later.
Let's do it.
LMI is it scares a lot of people off.
100%.
It scares a lot of people off. We were fortunate because it can be several $1,000s out of pocket. Yeah. Essentially what it is, if you don't have that 20% deposit, it's a few $1,000s in case you default because you don't have a high enough deposit. We were fortunate enough, to your point about finding specials, I guess is the best way to put it, discounts. Yeah. We bought at a time when one of the second tier banks, so a middle tier bank, not one of the big 4, but a bank that a lot of people would probably know. They gave $1 lender's mortgage insurance, which when you shop around, when you look at that and you say, well, immediately I could save a few $1,000s. Now the interest rate is marginally higher. Again, we've unpacked what a 0.25% cut is, $33 a week. You'd probably be happy to have $33 out of your pocket if it means immediately weekly, if you immediately save several $1,000s.
If it gets you in the market 12 months sooner, so you don't save that extra 10%, and in that time you've owned that property 700,000, it goes even 5%, that's 35 grand of growth that you've made by not saving that, by paying a premium of 5 or 10,000.
Yeah.
And just to put it in context, like lender's mortgage insurance is a one-off premium that the buyer pays when they establish their loan that protects the bank if you default.
Yep.
So it's only one-off. It's not like a home insurance where you pay every year. But it can also be quite hefty. It's based on the size of the loan. So the bigger the loan, the bigger the premium. The smaller the deposit, the bigger the premium. So if we're borrowing, 1.5 million at 94%, it's going to be huge.
Can you give an estimate?
40,000.
$40,000.
But if we're borrowing 50,000 at 85%, it might be 5, 6, 4, whatever. So it's important, and there's other options here as well. So first home guarantee scheme, where the government will guarantee your loan and you don't need lender's mortgage insurance. Again, there's criteria to meet to qualify for that, same as DHOAS or HBAS. You've got to meet the criteria, and that's why a broker is important to help you understand all that, all the criteria of the different entitlements. Or there's the bank of mum and dad. You might have 10% and the mortgage insurance premium might be, say, 9,000. But if you can bring in the bank of mum and dad to guarantee the other 10% that you don't have, your lender's mortgage insurance, you won't have it. So you can save that money. So there's multiple ways to avoid lender's mortgage insurance. What I will say is consider the opportunity cost. Some people will be out there, I don't have mum and dad that have got equity to loan me for the guarantor loan, or the property price that we're purchasing is over the threshold for first home guarantee scheme. Don't sit on the sidelines for another 3 years trying to save to 20%, because that's what we call opportunity cost. If it takes you 3 years, but the market moves, long-term average of property in Australia is 7%, but call it 5, 700,000, that's 35 grand per year over 3 years, 105,000 over that 3 years that you'll miss out on by saving to avoid lender's mortgage insurance. So the opportunity cost is much greater in most cases than the actual premium of the insurance.
Yeah.
It's just the cost of doing business.
Yeah.
Get into the market as soon as you can, start paying it down, build savings and offset, get growth with the property, and then you're in a position to, go into the next property. And I guess back to your original question, that probably opens up the segue back into, bank versus broker.
Explain the difference.
A bank is there to make a profit for the shareholder. A bank is a business that sells you their products. That's the long and short of it. They want to give you a nice home loan, and then they want you to have a credit card, and then they want you to have a bank account and a savings account and an offset account, and maybe even some insurance, and then further down the track some wealth advice maybe.
Throw it in, sprinkle it in.
A touch of this. So the bank, the more products they give you or sell you or meet your needs, I think the stickier you are or the harder it is for you to leave. But they're not going to tell you, if you're self-employed, perfect example is the old self-employed, and you've been in business less than 2 years, a lot of banks won't look at your financials or consider them until you're established for greater than 2 years. Yep. But there are some banks that will do it off 1 year only without looking, and there's some banks that will do it off 1 year but want to look at 2 years. If you go to a bank that wants to see 2 years financials for your business and your income's not sufficient for the loan in the first year, but it is in the second year, they're not going to give you the loan. They're not going to say, hey, pop down the road to bank X, Y, and Z, because they'll do it for you. They're going to say, come back in 12 months' time when you've got 2 consistent years.
They're not going to give you freebie advice.
No, that's right. But a broker is bound by the best interest duty. So they legally must act in your best interest. And they will say, well, the bank that you went to wants to see 2 years financials. But these 2, 3, 4 banks over here will do your loan and will find the best rate. So they will get you into the market sooner. So the broker navigates all the policy, and the policy is the most important part to getting into the market or getting your loan approved versus going direct to a bank to get sold products.
And there's no fee for service.
No, so a broker generally there's no fee for service. So I think I don't know a percentage, but if I was to put something on, it'll be 99.9. Brokers don't charge. Maybe a commercial broker doing a complex,
super complex thing,
things outside of the box, and that there can be no. But if you're fairly vanilla mum and dad, saving a deposit to buy your first home or buy your first investment or even your second or third investment, most brokers are remunerated by a commission from the bank. I don't even know, I was going to say a very small variance between the commissions that they pay that it wouldn't even come into consideration in my eye. And from my knowledge, most banks pretty much pay the same, and that's where best interest duty comes in, that the broker legally acts in your best interest to get you. But remember, it's always, you have to meet the policy first before rate. So if you go to a broker, the job's not, hey, what's the best rate? That's one component of it. But it's also got to fit your requirements and objectives of what you want to do. If you want to buy an investment property, for example, and the bank you're with doesn't provide or says you haven't got the equity or you haven't got the capacity to buy that investment property, there may be another, so they don't meet your requirements and objectives, but there might be another bank that will do it. So the broker will find that bank for you.
And a good broker, when they, after you do a discovery session and they start getting your information together and they present you, a good broker will present you with a very big suite of options, and they'll break it down with all those conditions and all those policies. As you said, it's policy first, interest rate second. So some of them might be, there might be an interest rate which is marginally higher, but you've got no annual fee. And so then when you do the maths, it's like, well, you're actually $20 better off going with a higher interest rate. So, and that's where you get the benefit from a mortgage broker. And I'll say this, as from my own lived experience here, if you're, and this could be anyone, I see a lot of people who have been very successful in the world of property, but they blindly trust what people say. Shop around for your broker as well, because that's what my wife and I did. And we had no idea when we were first starting out. We spoke to a broker and we were like, looking back now, this person was appalling. Yeah. And we're like, oh, is that just what they're like? I mean, do we stick with them or maybe? And I think she said something that was quite rude or dismissive. And we're like, oh, let's just cut it and go somewhere else. And the next person we spoke to, it was just night and day. Yeah, and then they're there, they're sharing their screen, they're explaining the basics. They're like, and this is what we do. And then they're pulling up examples and not spreadsheets in a hard, really big math way, but like, here's the top 20 banks that we're looking at and here's all the potentials where you could be. And you're like, well, this is what we wanted because this is someone that's actually taking us by the hand and saying, this is what your future can look like, and really going in that in-depth level. Yeah. So, my experience is, speak to them, give them a little bit of a test, because this is someone, if you find the right broker and Kane, what you do, and you help people expand their portfolios, we want our listeners to end up with some more properties. We want them to have
especially
many.
In the defence space as well. Yeah. Like, you don't want to go to a broker that says, don't worry about DHOAS, it's not worth it. Come over here and we'll get a sharper rate. Yeah. That's the perfect example that we've mentioned a few times. But I mean, the broker space has evolved so much, and then it's heavily regulated that you will get a good deal with a good broker. But like you say, you got to find a good broker. And for the defence space, you need to have someone that's familiar with incapacity payments or Class A and B pensions, DHOAS, is familiar with all the defence, I guess, way of life. But then, and you're not going to be married to your broker either. So what's right for you today might not be right for you in the future. Because as we've sort of touched on, investment strategies with lending and building a portfolio, the broker's the gatekeeper to the debt, and the debt is what allows you to keep building your portfolio. So you might transition away to a different broker over time. I mean, perfect if you can find the broker that's a specialist in defence and, knows how to build a portfolio. But the broker plays a critical role.
And even looking at what we're unpacking before, there are opportunities there, and those brokers will help you identify those opportunities. Yeah, it could be the rent vesting aspect. Yeah, so that can be a very complicated thing, the rent vesting side. we unpacked it a little bit before, which was there are going to be times where your rental assistance, you should stick with it. There are going to be times where you should stick with your rental assistance and look elsewhere, maybe look for a high growth area. Actually, a few episodes ago, I'll put the link in the show notes for this. You and I went base by base. And we've actually referenced this episode a lot because it was just it was a really good ep. Where you went base by base and you were looking at, I think it was Garden Island again. And you're like, well, actually, a lot of those properties around Garden Island, even units, they're in the millions, right? It's just not going to happen if you're not even just young in your career. Just for 90% of Aussies, you're not going to really be able to afford a $2.5, $3 million unit, right? Yeah. So that's a great example of where you should use rental assistance because you also balance it out with, you get an amazing lifestyle that even if you manage to get a bunch of inheritance and buy a $3 million unit, like it's also not going to necessarily appreciate as much in value. They might be going up a few % a year. Whereas if you parked your money elsewhere in some growth locations, you could be getting double-digit returns. We've seen Adelaide and Perth go by 15, 20% a year over the past few years if you're buying in the right suburbs. What does a rent vesting strategy look like with your philosophy?
I mean, it's I don't want to say it's a no-brainer, but like when we break it down, and let's just take defence out of it for a moment and just talk about rent vesting as a strategy. And you know, Sydney's eastern suburbs is the example. Not many people can afford to buy, you know, in say Bondi Beach or the surrounds, but they can afford to live there, renting. Right. So they rent the lifestyle they want. And if we were to open up some data and look at the median household price and the median rent in Sydney's eastern suburbs, the yields are probably, depending on, you know, house and unit, anywhere from like 2% to 2.5. Yeah. Like 3 would be considered good, dare I say. But you can afford to rent there. So it's actually cheaper for that lifestyle to rent there and then just go buy an investment property, use some data and buy in a better market that's, you know, positioned for some growth. Then when we bring the defence side into it, and this isn't just for Sydney's eastern suburbs, this goes Australia-wide, someone's going to pay half your rent for you or 30, 40, 50% of your rent, depending on rank, region, marital status. Like cash in on that. Like $300 a week in rent assistance, $15,000 a year that someone's paying towards your rent to allow you to be in a better position to build an investment portfolio. And there's no downside. You don't miss out on DHOAS. So really,
for later down the track.
That's right. Yep. You use DHOAS later when you want to actually buy a home and where you know where you're going to live, where you're going to have kids long term and go to school and all that. And this is the forever home that we're going to pay off. While you're in defence, rent, build wealth in good markets. The caveat is you got to buy. There's no point. You can't rent invest without the vest. So you got to buy in some sort of market. So the strategy is focused on, do I buy a home or do I buy an investment? The rent vesting is the solution or the answer. In most cases, but you know, you're going to have you pay full freight on everything when you're buying an investment because the government or your first home owners grants, entitlements, guarantee schemes, they're all there to help you buy a home. None of them are there to help you buy an investment. So you do have a higher barrier of entry when it comes to the deposit required to get into the market. Where it may make sense to not go down the rent vesting path is to get into I guess we called it the supercharged rent vesting strategy, but you got to take a step into use DHOAS. So this is for someone with a smaller deposit, potentially talking to the single serving member earlier stages of the career, but they've been saving diligently and they've got, you know, 5% saved. You know, but then that might equate to 30, 35,000 in savings. It might take them another 3 years to get to a big enough deposit to buy an investment. So the opportunity cost that we were talking about earlier comes into play. Am I better off, okay, let's buy something, live in it, use HPAS, first home guarantee scheme, DHOAS, get started by it, then we've got exposure to the market where it's going to grow with the market. But then we want to look in that scenario to get posted away to a different region where we can go back to renting, where the fence is going to help us and provide us rent assistance. But we've got DHOAS on our investments, then we've got both going at once. And we essentially would then want to avoid getting posted back to that locality because we'd have to live in it if we did. And then we're away, we're in the market, then it's just a matter of when the market grows enough in value, if we can save a bit while we're in, tap into some equity and then start building the portfolio from there. But if we can actually invest without having to buy and live in it first, that's the ideal strategy because you're giving up for that period that you live in that property, you're giving up the rent assistance. And if we work out $300 a week, say that's $15,000 a year, that's more than top tier DHOAS.
You're very quick with the maths.
I've had this conversation many times over. And unfortunately, there's no textbook that says do this, do that.
Yeah.
It is very situational dependent.
Oh, for sure. I mean, like if you're...
Deposit size impacts it, locality, Sydney versus Wagga Wagga.
Yeah.
The median price, Sydney, most people are just never buying an own occupier. I've not met one person... defence that says, I'm living in Sydney, I'm going to buy an own occupier near Garden Island,
it's not.
Unless you're going to drive 2 hours to work or whatnot. So there's so many variables like the length that you've been in defence, the length that you expect to stay in defence. Do you know where you're going to live post separation? There's so much that comes into play.
There's a few things on the horizon as well, which, I think it's worth flagging for a lot of our listeners, especially in the first home buyer space. Well, actually, no, not just first home buyers, because I think it's going to lift all, it's going to be a rising tide that very much lifts all ships. So as of January, the government's new first home buyer scheme is coming in. And what that means is your first home buyer grant is going to go to, I think, $30,000. Do you have the number? I think I'm 99.99% sure it's $30,000. So they're going to increase your first home buyer's grant, which is really big. There are a few other points there which are worth highlighting for our listeners as well, because there were a few restrictions. Now, I'm speaking from New South Wales' point of view. I don't necessarily know the legislation in other states, but in New South Wales, our first home buyers grant was limited to new builds, and I think it was capped off at like $600,000. And this was 1 or 2 years ago.
Yeah.
And you're going to be thinking, hey, Garmo, where am I going to buy a place for $600,000 in Sydney? Yes, good point. You're not. So
long and short,
it's not going to happen.
Anyway.
And and
you
a lot
car
of
park for that in the city, can't you?
Oh yeah, I mean that's a cheap car park. And a lot of people, a lot of young buyers get very, they beat themselves up over it. And I see it often where people, I wish I got my first home buyers. I wish I got my first home buyers. But realistically, if you're buying a PPOR, it's not going to happen unless you are, living several hours out in a new build where you can't even validate how good the new build is. You and I have spoken about off the plan selling before on previous podcasts, but I was looking through a government report only a few weeks ago released in 2023, and in 2023 it was co-authored by the New South Wales government and the New South Wales Strata Association, and they found that 52% of new build apartment buildings had quote unquote serious defects.
Oh yeah,
6 years.
I saw that on the news.
Like 52%. So you're and that's within 6 years. So I mean, I'm going to guess after 10 years the number's probably a bit higher as they start going through. So you are rolling a dice, and 50% of the dice rolls are going to be they're not going to land in your favour.
And if we forget about the first home buyer side and look at the investment side, a lot of people default to, there's less maintenance on a new build.
Well,
not when it's a dodgy build.
Not when it's a dodgy build, right? Yeah. And
how do you verify the builder?
Yeah. I mean, they were just once it starts coming through, they declare bankruptcy and wrap up. So to get the first home buyer stuff, you are so limited in your pool. But what's happening as of January is that condition for new and old build has been lifted.
Yeah.
It's also the cap has also been lifted as well. So my understanding is it's the median house price for the city plus roughly 10%. So in Sydney, your first home buyer's grant is going to be up to, $1.5 million-ish.
Yeah.
Now, Sydney is not really where we would necessarily be focusing. Think of it if you are posted to Townsville, think you're posted to Brisbane. This is huge because in those markets, if you've got a $30,000 first home buyer's guarantee, you've got the government guaranteeing. So the government is looking to guarantee LMI. So you won't have the LMI. You can have the 5% deposit. tying into the LMI, you are going to have a huge influx of capital into these major cities in a way that I just don't think we've seen it before. So to your point earlier, and I thought it was like a really good point. It was simple, but it was, to be a rent investor, you need to do the vest part, right?
Yeah.
Don't necessarily sit on the sidelines, because you will face that opportunity cost, which you mentioned before, that potentially in 4, 5, 6 months, you're going to have hundreds of thousands of Aussies now able to enter the market. This is a demand side part of the equation. House prices aren't going to stay the same. It's not going to be like
and interest rates coming down over
interest
the next
rates coming
6,
down as
12
well.
months improves the demand side, opens up regions. So
the interest rates as well. House prices aren't going to if it's 500 grand today, it's not going to say 500 grand later. Now that suddenly 100 more people are going to be looking to buy that house.
Yeah,
it will go up. And it will go up relatively because there's going to be a new market price for things if there's going to be that many billions of dollars pouring into the market. So, to your point earlier about you have to do the investing if you're doing rent investing, and the opportunity cost, don't be scared off by some of these things, because I don't necessarily think that those double-digit returns, those 10, 20% returns that we've seen year on year in Brisbane, Perth, Adelaide, I don't necessarily think they're over in a lot of areas.
Yeah. And you bring up a good point, like things like the interest rate and changing fiscal policy around first-time owners grants, and these are all macro environments that impact the broader supply and demand of home buyers and new stock and stuff on the housing market. But when we get into the weeds, for every suburb region we buy, and we can look at the individual supply and demand metrics for that area. So supply and demand ultimately determines price movement of anything. So a suburb is no different to anything else, where we can actually look at the individual stock on market, like the percentage of properties for a suburb on the market, the inventory levels, the building approval ratios. If a suburb's got 20% building approval ratios, supply is the enemy of growth, and it's not going to grow. Versus if it's got 1% building approval ratio, there's a very scarcity about that suburb, and there is no new supply, so demand's going to be able to drive prices higher faster. So understanding and where you're buying and what you're buying is important.
And we did cover that off on a few chats ago, where to be really logical, right? Like if we're sometimes we can use the economic terms for it because we are so in the weeds with this, but if you look at it logically, and you've got a house in regional New South Wales, and you love it and it's fantastic, and this is where you've planted your roots, and then suddenly 2,000 homes are built in the small town. Your house is not unique anymore.
No.
Your house is not only unique, as you pointed out before. Some people, I'm not necessarily a new build guy, but some people love new builds.
Yeah.
Some people love the amenities, and your house is no longer unique. So the supply metrics are fundamental, and there are places where some governments, and we do need supply for affordability, and don't get me wrong, we definitely do need supply for affordability, but supply is also not evenly distributed across postcodes.
No, that's right.
There are areas in Melbourne, in Brisbane, even think of it like the southwest Sydney corridor, which a lot of our Holsworthy people would be very familiar with, and you just have brand new suburbs that just literally didn't exist 2 or 3 years ago, and they're popping up. If you had a house in those areas, it's not unique anymore. But if you do find those pockets where things just are not getting approved for whatever reason, but you still have the demand, you still have people wanting to live in that area, it still has families, it still has people that want to stay there, that have jobs there, they're going to experience an abnormal bump.
Yeah. No, 100%. I think you nailed it.
Fantastic. Well, Kane, conscious of your time, I think that is all we have time for today. Now, people that want to get in touch, how can they get in touch?
Yeah, Discover Buyers Agency or Discover Buyers Agency on Instagram. We're putting out lots of content there.
But you're everywhere now.
Even TikTok, they say.
Oh, yeah. Well, I'm hoping none of our listeners have TikTok. I don't think any of our listeners should be able to verify that. Okay, well, you got your social media person to do it for you.
Yeah, that's right. No, but reach out, jump on the website and just fill out the form and happy to have a chat with anyone that's whether you're a veteran of 20 years service or the first, second year of service or a gap year. Reach out, always happy to have a chat and see if we can break down a bit of a strategy to maximise some of these entitlements, but also start building the portfolio.
Hell yeah, get on board because in just a few months, look, this isn't financial advice, but, just read the news.
Yeah.
Because there might be a little bit of a bump on the horizon. That is all we have time for today. Kane Dury and Liam Garman, co-hosts of the Defence Property Podcast, and we'll be back at the same time in just a month. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.